Good morning, ladies and gentlemen. Thank you for holding and welcome to the Takeaway.com half-year 2018 results call. At this moment, our participants are in listen-only mode. Following the presentations, there will be a question and answer session. I would now like to hand the call over to Mr. Jitske Groen. Go ahead, please, sir.
Thank you, operator. Good morning, everybody, and welcome for the second time this week, and this time for the Analyst and Investor Conference call to discuss Takeaway.com's half-year 2018 results. On our corporate website, you can download the half-year 2018 results press release, the slides for this Analyst and Investor Conference call, and all other related information. I will start off today's presentation by taking you through the highlights of the first 6 months of 2018, and with a short recap of the rationale for the Tembis transaction, which we announced a few days ago. Jörg Gerbig, the Lieferando founder and our current COO, will update you on the progress we made in Germany and Poland. And Brent Wissink, our CFO, will then talk you through the financial details of the results at group level and for each of our three segments individually. I will conclude the presentation with our strategic priorities, including the progress that we have made on the medium-term objectives in the first half of 2018, after which we will open up the call for your questions. On slide 4, the efficiency of our investments in future growth are demonstrated by the continued growth of our active consumer base, which now totals 12.6 million customers, an increase of 24% compared with the first half of 2017. This resulted in nearly 42 million orders in the first 6 months of 2018, a growth rate of 30% compared with the first half of 2017. These orders represented a gross merchandise value of more than 800 million euro. The growth rate of the GMV was slightly higher than order growth, driven by higher average order values. The increase of orders and the growth of our average commission rate resulted in a revenue of 110 million euro in the first 6 months of 2018, up with 42%, demonstrating our strong revenue generating capacity. This led to a gross profit of 92 million euro. Marketing expenses increased to 65 million euro in the first 6 months of 2018, which is a modest increase of 11% compared with order growth of 30%, reflecting the scalable nature of our business and the strong performance of our existing consumer base. Marketing as a percentage of revenue improved in all segments during the first 6 months of 2018, again compared with the first half of 2017. As a result, adjusted EBITDA for the company was minus 6.1 million euro in the first 6 months of 2018, compared with minus 15.5 million euro in the first half of 2017. This improvement demonstrates that Takeaway.com is well on track towards profitability, while it is still investing heavily in the business as part of its growth strategy. Although Takeaway.com will continue to invest, we expect absolute losses to decrease going forward. On slide 5, I want to repeat 2 of the slides that we have also shown during the webcast last Monday, in which we provided further background on the Tembis acquisition. As you will likely know by now, we have signed an agreement to acquire 100% of the shares of Tembis in Tel Aviv from TA Associates and its founder Tamir Kamel for a cash consideration of approximately 135 million euro, which will be financed by means of a committed bridge facility of 150 million euro. To summarize, Tembis is an online food delivery marketplace that provides employee meal benefit plans to thousands of corporations, representing hundreds of thousands of employees. It essentially replaces the corporate canteen. Unlike Takeaway.com, 95% of Tembis orders are B2B orders. However, it is also the local market leader in B2C, which is currently underdeveloped but growing rapidly. Over the past years, Tembis' performance showed stable growth rates from a sticky corporate user base, resulting in exceptionally strong cohorts. Its users order multiple times more frequently than the Takeaway.com users. Now I would like to share why we are so excited about this acquisition of Tembis. Firstly, B2B offers a large addressable new market for Takeaway.com. Tembis has proven B2B technology, which will be integrated with Takeaway.com's offering to unlock a significant addressable market in Europe. Secondly, Tembis is one of the few highly profitable food delivery marketplaces globally, with a 43% EBITDA margin in the year 2017. Well-run, profitable acquisition targets in sizable markets are difficult to find, and we are glad that we managed to acquire Tembis. Thirdly, Tembis is the local market leader in B2B and B2C. We believe that the local B2C market is highly underpenetrated. Takeaway.com, with its 18 years of experience in B2C, will increase marketing investments and will roll out Scoober in the B2C and B2B market locally. And lastly, the transaction is in line with Takeaway.com's growth strategy. In case of acquisitions, we focus on businesses which are either the market leader or businesses which have a chance of becoming the market leader. Tembis fits that picture perfectly. On the next slide, I will elaborate how we see the two businesses reinforcing each other. On slide 6, we provide a more graphical presentation how this transaction will generate a two-way B2B and B2C opportunity for the combined businesses. On the left-hand side, you can see that both businesses benefit from a proven platform and business model. Takeaway.com, of course, has Scoober, which will be rolled out to Tel Aviv in the coming period to enhance the offering and become more visible on the streets, thereby further strengthening the brand. At the same time, the combination of the highly complementary Tembis B2B technology with Takeaway.com's single platform and 12.6 million European consumers offers an appealing added upside to the combined businesses, which will lead to a higher order frequency of existing consumers and enhances also at the same time our addressable market. And lastly, Takeaway.com's 18 years of experience in B2C will benefit the Tembis B2C offering. For instance, we will increase marketing investments and we will roll out Scoober in the B2C and B2B market locally. The picture on the right-hand side speaks for itself. The key message, of course, is that due to complementary strengths, both businesses will reinforce each other, and that is the main rationale for this transaction. The triple play combination makes it increasingly difficult to compete with Takeaway.com. I will hand over to Jörg, our COO, to give you some more color of our performance in Germany. He will also give you more insight into developments in Poland, a market in which Takeaway.com is now a very sizable player and which continues to be the main driver of growth in the other leading market segments.
Thank you, Jitse, and good morning to everyone. In the first half of 2018, Germany continued its strong performance, growing at 45% in revenues and 34% in orders year over year. It was the second consecutive quarter in a row in which the growth accelerated. This is a reflection of the healthy condition of the business. On page 9, you can see the marketing spend dynamics in Germany. It shows the relative gross offline spend as measured by Nielsen. As you might remember from prior presentations, this offline spend predominantly includes TV and outdoor advertising. Most of the online spend is not covered. We believe the investment in brand awareness marketing is crucial to build sustainable brand value and build out market-leading positions to generate high and sustainable EBITDA levels going forward. As you can see from the graph and the table below, in the first half of 2018, we continued to outspend brand number 2 and brand number 3 together. Our spend exceeds that of the number 2 brand by more than 70% and is more than 4 times the level of brand number 3. This further strengthens our leading position in terms of top-of-mind brand awareness. In our half-year figures, we are not providing a split of marketing expenses by country. However, it is worth noting that overall marketing expenses increased by only 11%. Germany is the largest contributor to these expenses. This relatively modest increase compares with revenue growth of 45% and order growth of 34% in Germany. Consequently, marketing as a percentage of revenue improved in the first half year of 2018 also for Germany. This reflects the scalable nature of the business and the strong performance of our existing customer base. On page 10, we are showing the relative market share development based on Google Trends, Comscore, and Alexa. Google Trends is based on search requests for the brand name, reflecting the strengths of our brand and representing a good approximation for relative customer acquisitions. Comscore and Alexa is based on visitor data, which is a good approximation for our market share in terms of number of orders. Google Trends on the left side ended up at an all-time high. We had 64% of brand searches ending up with Lieferando.de, the local takeaway brand, which is up by 8% as compared to H1 17. We're confident in assuming that the majority of new consumers, one of the major drivers of our business growth, continue to end up on our marketplace in Germany. At Comscore and Alexa, the trend is also intact while fluctuating a bit for Comscore. Comscore in the middle chart ends at 58% and Alexa at 51%, up both 3% compared to end of June 2017. In summary, our growth in H1 2018 is a result of our strong network effects. The data points presented reflect the progress we made. Let's turn to Poland. Poland remains, as you can see on slide 12, our fastest growing leading market with GMV growth of more than 60%. We continue to build out our leading position in Poland. In the first half of 2018, we accounted for 62% of the marketing spend, despite our main competitor reinitiating marketing spend in H2 of last year. Page 13 shows the relative market share development in Poland. Unfortunately, Comscore discontinued tracking data for the Polish market, so we remain with Google Trends and Alexa. For Google Trends, we continue to assume more than 60% of brand search requests as shown on the left. We also continue to have a very strong share of overall web and mobile traffic at around 80% as indicated on the right side chart. This comes despite significant investments from competition in marketing and demonstrates the sustainable strength of our leading market position in Poland. It is worth noting that the overall market is growing rapidly. Maintaining our market share at levels of 80% actually implies that the absolute gap to the number 2 brand continues to widen. I will now hand over to Brent Wissing for the CFO update.
Thank you, Jörg, and good morning, everybody. Please move to slide 16. I will start with highlighting the main drivers for our order growth. Primarily, this was the increase in active customers to returning active as a percentage of total active customers and stable order frequency of returning active. These metrics have a multiplier effect on order and revenue growth, and they are a testament to our sticky customer behavior, driven by brand loyalty as a result of our marketing efforts. In particular, I would like to highlight that despite the limited incremental marketing spend, we grew our active customer base and improved the return rate and order frequency of our returning active customers. If you turn to slide 17, you can see the result of the improved metrics in the previous slide. The number of orders processed in H1 18 was 42 million, an increase of 30% in comparison to H1 17. All leading markets contributed to this growth. Particularly pleasing for us is the acceleration of order growth in Germany, now the second consecutive period in which our quarter-on-quarter growth has increased. Now on slide 18, where we show the gross merchandise value, or GMV. This is the total value of all food ordered on our platform. This is a function of number of orders and average order value. The GMV grew slightly faster than orders in the first half, due to a higher average order value, which was driven solely by the pure marketplace orders. Slide 19 shows the revenue development of our company. As you can see on this slide, our revenue increased to 110 million euros from 77 million euros, or 42% year over year. The growth is broken down on the next slide. Please turn to slide 20, which shows the breakdown of our revenue growth. What can be seen is that the increased GMV accounts for 29 percentage points of the revenue growth. Higher commission rates account for 9%, and the remaining 4% is driven by growth in online payments and other revenue. Now on slide 21, you see the gross profit. Gross profit increased to 92 million euros from 65 million euros, a year-over-year increase of 41%. This growth was slightly lower than the revenue growth due to the impact of Scoober, which as a percentage of orders is currently at 2.3%, around twice the level of a year ago. As you all know, the Scoober business has a structurally higher cost base due to the logistical element. Excluding Scoober, our gross margin would have increased by 1%. Slide 22 shows our cost components. This shows our operating cost and cost of sales. However, this excludes non-recurring cost items. Our costs increased slightly more than 25%, mainly driven by staff costs and Scoober investments. We are pleased to report that our marketing spend increased by just over 11%, demonstrating our economies of scale. Please proceed to slide 23. Here we show the adjusted EBITDA of Takeaway.com. Adjusted EBITDA is calculated as profit or loss for the period before depreciation, amortization, finance income and expenses, share-based payments, and joint venture results. Our adjusted EBITDA improved compared to H1 17 from minus 15.5 million euros in H1 17 to minus 6.1 million euros in the last half year. The main reason for this were realized economies of scale in marketing and improved efficiency of the Scoober operation. The improved EBITDA is visible in all segments. Our Dutch EBITDA further increased compared to H1 17, and both our loss-making segments, Germany and other leading markets, also decreased their losses. With respect to our profitability in 18, we continue our commitment to decreasing our absolute losses going forward. Now we will move on to look at our other three segments in detail. Firstly, the Netherlands on slide 25. Orders in H1 18 grew by 21%, from 12.9 million in H1 17 to 15.7 million in H1 18. This also includes the growth of the Scoober business. Scoober orders represent 2.7% of the orders in the Netherlands. GMV reached over 320 million euros in H1 18, growing slightly faster than orders. This was a result of a higher average order value of pure marketplace orders. Now turning to slide 26. Revenue grew by 34% in H1 18 to 47 million euros. Apart from GMV growth, this was also impacted by an increase in the average commission rate of more than 1%. Our absolute adjusted EBITDA increased by 5 million euros, in line with our medium-term objectives. Please now turn to slide 27 to review Germany. Orders grew by 34%, which was a significant acceleration compared to Q1. GMV increased faster than orders due to a small increase in the average order value of the pure marketplace orders. On to slide 28. Here we can see that the revenue grew 45% in H1. This exceeds the rate of GMV growth, mainly due to the higher average commission rate. If we break down the impact that caused the revenue growth, increased GMV accounted for about 75% of the revenue growth, with the remaining 25% caused by a higher average commission rate, online payments, and other revenue. Looking at EBITDA, we can see that the margin improved from minus 88% in H1 17 to minus 53% in H1 18, with our absolute losses decreasing as well. Our success in Germany is not currently measured through EBITDA, but by market share, for which I refer back to Jörg's slides on our market leadership in Germany. Please continue to slide 29. Looking at the other leading markets, you can see that these markets continue to perform strongly. The growth in customers led to increased orders in GMV. The average order value increased by 10 cents, driven by a higher average order value in Poland, Belgium and Austria, as well as an increase in the Scoober share, which increased nearly sixfold to 2.3%. The Scoober share accelerated due to the addition of Bulgaria and Romania in Q2. Now we turn to slide 30. Here you can see how we have delivered excellent top-line growth while reducing our EBITDA loss, again due to our realization of scale benefits, particularly in marketing. However, due to the low penetration in these markets, we do not use EBITDA as a marker for success at this stage. Nevertheless, our adjusted EBITDA was minus 10.5 million euros, representing a margin improvement of 35 percentage points compared to H1 17. That concludes the financial section. I will now hand over back to Jitse.
Thank you, Bernd. I will continue with slide 32. Our strategy has been consistent for the past 18 years and will remain consistent. We are focused on expanding our market leadership positions as we believe that this is the only way to achieve high margins, as we have demonstrated in the Netherlands. We will do so by focusing on our single brand in each market and by investing in brand awareness, which will lead to improved marketing efficiency over time, one of the key levers in our profitability. We will also continue to evaluate our performance in each market and may divest or acquire businesses based on strategic fit and our market position. Our own developed technology is one of our key strengths, and we will continue to focus on the strength, security and scalability of our backend, as well as continuous improvement in our user interfaces. Finally, we will continue to expand both our restaurant offering and our Scoober business to add further value to our network and to offer an ever wider selection to our customers. On the next slide, I would like to discuss the progress we have made on our medium-term targets. Our order growth well exceeded the 25% per annum objective, with a compounded average growth rate of 40% over the period 2015 until the first 6 months of 2018. Revenue growth continued to outpace order growth with 42% and 30% respectively. We have made clear progress with regard to profitability, while we continue to invest heavily in the business as part of our growth strategy. Adjusted EBITDA margins in both the Germany segments as well as for the company as a whole improved in the first 6 months of 2018 compared with the full year 2017. And lastly, the adjusted EBITDA in the Netherlands further increased to 25.3 million euros in the first 6 months of 2018 compared with 20.5 million euro in the first half of 2017. Now moving to the conclusion of this presentation on slide 34. I'd like to finish off this presentation by saying that Takeaway.com has taken further steps in the execution of the plan laid out at the IPO. Our revenue generating capacity and continued strong order growth in the first half of 2018 shows the effectiveness of our growth strategy. Scoober continued to grow strongly in the first 6 months of 2018. We've expanded to 8 additional cities, bringing the total to 31 cities in 8 countries. The important thing to note here, though, is that the efficiency in Scoober continued to increase as well. Consistent with Takeaway.com's one company, one brand and one IT platform approach, the acquired businesses in Bulgaria, Romania and Switzerland already have been fully integrated into our global technology platform. As mentioned earlier, marketing expenses increased modestly compared with our order growth, reflecting the scalable nature of our business and strong performance of our existing consumer base. Marketing as a percentage of revenue improved in all segments during the first 6 months of 2018 compared with the first half of 2017. As a result, adjusted EBITDA for the company was minus 6.1 million euro in the first 6 months of 2018 compared with minus 15.5 million euro in the first half of 2017. This improvement demonstrates that Takeaway.com is on track towards profitability, while it still invests heavily in the business as part of its growth strategy. Although we will continue to invest, we expect absolute losses to further decrease going forward. All in all, we are well on track to achieve the medium-term objectives, despite our increasing investment in marketing and Scoober and the added operating expenses of our acquisitions in Bulgaria, Romania and Switzerland. Taking this into account, we are ahead of plan to deliver on the medium-term objectives. We will continue to invest in our proposition to our consumers and restaurants through technology, marketing, product development and our Scoober restaurant delivery services to provide a best-in-class user experience. We are pleased to have achieved such strong revenue and order growth in the first 6 months of 2018, which builds the basis for future profits, and we believe that we are well positioned for further growth. And with that, operator, I would like to open the call for any questions that you might have.
Thank you, sir. Ladies and gentlemen, we're starting the question and answer session now. If you have a question or remark, please press star 1 now on your telephone. Star 1 for your questions or remarks. Go ahead, please. Our first question is from Mr. John King of Bank of America Merrill Lynch. Go ahead, sir, your line is open.
Yeah, good morning, thanks. I've got 3 questions, please. First question, probably for Jörg, was in Germany. Do you feel like the strength in the traffic and brand awareness that clearly is evident in the charts on slide 10, is that applying through to orders, or is it possible that competition is, seeing better effectiveness with their marketing at this point? I mean, I guess the one chart on the Alexa data does seem to show some kind of leveling off in the last in the last 18 months or so. So some comments on that would be interesting, and maybe I'll let you answer that first.
All right. Well, actually, these are of course indications, but we also hear other things in the market. I think it's highly unlikely that our competitors has better effectiveness simply because their brands are much smaller than our brand. But I think we'll have to await figures from the competitor to actually confirm that.
Yeah. That in terms of the effectiveness, on the contrary, actually, given we have the largest restaurant network, so in terms of restaurants where you can actually order and not just purely which are listed, our restaurant network is about 20-30% larger than that of competition. So in theory, the conversion rate of traffic should even be better than that of competition.
Understood. The two other ones, number one was on the chains, the QSRs. I guess we look at Scoober in Netherlands has picked up significantly in the half. I assume that's driven by chains. Maybe you could just talk about whether those larger chains put some pressure on your commission rates, if the economics are the same there, or maybe are more favourable for the restaurant if given the scale. And then the third question is on the Netherlands and a bit of a slowdown in Q2. I guess maybe weather played a role there. Is that the case? And if so, does that have an implication for Q3 in the Netherlands? Thank you.
Well, first answer your last question and then relay the question for Jörg regarding Scoober. Regarding the weather, we haven't specifically mentioned that, of course, in our press release because the weather is it's the weather. It's there. We can't really influence it. The results of weather typically, at least if you would look specifically at the Netherlands, is that in the first 2 weeks after the weather turns favorable for human beings, not for food delivery websites, but for human beings, is actually that you see a slowdown in order rates from existing customers. We don't typically see an influence on new customers, so we're talking about the existing user base. That is due to people going to go barbecue or that they actually go sit outside, which is a logical thing, of course, to happen. Normally after 2 weeks you will see a return to normal order patterns. The more important issue, however, is the lack of rain. Of course, everybody understands that if it rains, that typically and food delivery websites will get more orders because people don't like to go outside. So rain has a big influence, and we haven't had rain, I think, we had some rain, but I think actually the grass, actually that I can see from this office is yellow, and I can tell you the grass in Holland is typically green. So that is a big influence. That having said, we're still quite satisfied with the orders given the weather, because it has been unseasonably warm in the past 3 months. Now you have to bear in mind that the effect on a country like Holland is greater than the effect on a more or less landlocked country like Germany, because Germany has a land climate and Holland has a moderate sea climate. So in Holland, normally, actually, when the wind is from the west or from the north, it could actually become quite cold in summer. That hasn't happened this year, and I think the whole population is very grateful for that. But that's not good for food delivery. So the impact typically on Holland would be greater than the impact on Germany. So I think that's to weather. And I think then, Jörg, you can best answer the questions regarding the chains and Scoober.
Yeah, with regards to the chains and Scoober, I mean, you're right, it has increased significantly. The number of orders has increased from 1.2% to 2.3%. It's driven a lot by chains which we were adding, for example, KFC, Burger King, Quick, or Five Guys, just to mention a couple of those. You're also correct in saying that obviously there is some discounts on the general commission rate, so there is a bit of more pressure on the margin side, but also on the average basket side, because some of these, for instance, fast food chains have lower basket values. So it puts some additional pressure economically on the Scoober side. However, these are very strong brands, and there's for sure a strong demand on the consumer side for those. And if you remind yourself, we're doing it for the network effects. We already stated earlier that Scuba business is a challenging business from the economical side, but we can really see that there is a huge consumer demand for these type of brands, and we see that this further fuels the network effects, and that's why we're actually happy that we can work together with these chains on the Scuba side of the business.
Got it. Thanks, guys.
Thank you.
Our next question is from Ms. Miriam Adisa, Morgan Stanley. Go ahead, your line is open.
Hi, good morning, guys. Two questions from me. Firstly, just following up on the last question on the order growth in the Netherlands. Given the slowdown, despite the pickup in Scuba, I'm just interested to know if you still believe orders from Scuba are largely incremental, and if there's anything you can share in terms of cohort behavior, that would be great. And then the second question, so the losses in other were better than expected. If you could just give us a bit more color on the mix, where you're seeing the efficiencies, particularly again since you saw the bigger increase in the share of delivery orders as well. Thank you.
All right. Regarding the question about the Netherlands, I think you should see the Scuba growth apart from the general growth, because Scuba growth is usually influenced by adding additional cities or additional restaurants. And of course, in case you add a chain like KFC or Burger King, then you add quite a number of Scuba orders. We do believe that is mostly incremental. We're quite sure that part of the orders that would go to a different restaurant might go to Scuba, but it is mostly incremental, and you have to bear in mind that our Scuba service is becoming quite large. If it were an individual business, for instance, here in Holland, we would believe that it is the largest logistical service already. So it is a large service that has a large marketing exposure factor. We do have a lot of drivers on the road, and actually it's quite good for the order rates in the cities, actually causing more orders, and we can actually measure that it's getting us more orders than in the case that we weren't running Scuba. So if you look at Holland specifically, it's very much related to existing customers, so not new customers, and existing customers order less frequently. Can also turn it around. If it actually would have rained sometimes, then we would have had far more orders. So it's a bit on the way you look at the business. I think the second question is best for you to answer the losses in the other segment, whether they are related to, I think, a better efficiency of Scuba, if I'm correct. Is that the question?
Yes, and anything else that might have gone on in there as well.
The improvement, you mean the improvement is in profitability in the other segment? That was your question with that too?
Yeah, I think the consensus had significantly higher losses there, so just wondering if there were any change in dynamic there.
I mean, one of the major driver in the other segment, that's Poland, and we've noticed a very strong GMV growth in Poland, which was north of 60%. And again, coming back to the marketing expenses, which only increased by 11%, that is for the whole company, but still you can draw some conclusions also on the other segments. We also see some nice scale effect and efficiency on the marketing side coming through, mainly driven, as said, by Poland, which led to an improvement of profitability also on the other segment.
That is more or less that all the three leading markets, Poland, Belgium, and Austria, contribute to that improvement. You see a margin improvement all these three segments.
Great, thank you.
The next question is from Mr. Giles Thorne, Jefferies. Go ahead, sir, your line is open.
Thank you. I had a couple of questions, please. Firstly, on competition in the Netherlands. It looks like the Netherlands has now joined the UK as a country where Deliveroo will look to be onboarding restaurants that don't actually need deliveries done for them and therefore take themselves deeper into your marketplace heartland. We've been grappling with the potential impact of that on Just Eat in the UK for a while. Perhaps you'd like to give your view on how that impacts the Dutch market. And then secondly, to try and frame the long-term outlook in Germany, a reasonably high-level picture, but in your experience, what level of relative order size is the cut-off point at which the network effects of the business model mean that any market leader in a country has basically become unassailable? Is it twice as large orders or 10 times as large orders? The track record of M&A has certainly given us a sense of where that number is, but I'm not sure you've ever been asked directly. Thanks.
All right. Regarding the first question, I can almost guarantee you that Deliveroo moving into, let's call it marketplace orders, will have zero effect on us. It will have an effect on Deliveroo. Deliveroo here is quite small, as said. We believe it's smaller than Scoober. And I can give you a very simple example. Let's say a logistical company is doing 10,000 orders a month, and it has 100 restaurants. Let's say you double the amount of restaurants from 100 to 200. Well, that means that the marketplace, the logistical player, will have maybe a little bit more orders than in the previous occasion, but probably will have the same amount of orders because the marketplace doesn't improve in brand awareness or in customer base. Customer base is still the same. So actually what will happen is that you will dilute the orders that will go to your logistical restaurants, which is actually good for us because we're already probably larger than the logistical companies here in Holland. So we would actually relatively grow for these type of restaurants. Now, these are very small players, so the amount of orders that is in, let's say, the other half of the orders that is going to be available then for marketplace orders, if you get to a 50-50 restaurant share, that is going to be, per restaurant, a very low amount of orders. And I don't think you can ever match and I don't care whether it's also another large marketplace in other countries, the larger marketplaces are always bigger and will always provide these restaurants with more orders. So also from that perspective, without additional investment, and please bear in mind that the Dutch website is not running for free. It's costing tens of millions of euros on a yearly basis. I know it's highly profitable, but it still also costs money. Well, unless you're going to be willing to invest that type of money for, let's say, 10 consecutive years, you're not going to make any impact on us. So we're not worried about this, and I don't even think that Just Eat should be worried about that, but that's my personal opinion. Then regarding the long-term outlook for Germany, you're basically asking us where the tipping point is. Well, there is no real tipping point. What will happen and what you've seen happen in basically all the markets in which there were multiple players, like for instance Holland, Belgium, the UK, also more recently in Poland, what you will see is that the bigger player is just going to be in a far better position than smaller players to attract the most new users. So you will get to be in a situation as the number 2 or the number 3 that actually the most sensible thing to do for you is to cut back on your marketing, because you can never overtake that market leader anyway. And your marketing spend is typically less efficient because you have less restaurants, you have less brand awareness, you're just smaller in size. So actually a sensible thing to do is to become profitable. Now that sounds pleasant on the short run, but on the longer term you're going to shrink relative to the market leader. It doesn't mean you will disappear. You will still have users, and as long as you're not spending marketing, everybody can see that marketing is the biggest chunk of our costs. So if you're not spending marketing, you will be profitable. I think for investors the more important question to answer is whether that's a sound return of investment, and typically that's not. And this is why you see in most countries that the market leader takes over the number 2 or the number 3 player. And also from looking at that from the other side, it is always interesting for the market leader to acquire a sizable number 2 or 3, because those are just new users to that marketplace. It are existing users for the number 2 and 3, and they won't move easily to the market leader. But you can still, as a market leader, add all those new users, and you've seen that recently also with Hungry House entering the Just Eat user base.
Thank you.
Thank you.
The next question is from Mr. Mark Hesselink, ING. Go ahead, your line is open.
Yes, thanks. The first question is on the cost outlook, especially on the marketing side. What are you expecting from incrementally on marketing spend going forward in the markets? And then secondly, also maybe on the rest of the business, so the sales force. I've seen that there's a big uptake in the restaurant count. Obviously, that includes your acquisitions. Are you still speeding that up to invest there more and therefore increase increase the restaurant count. And the third question is on Poland. It seems that there the competition is becoming a bit more active. How do you see that, and does it impact you, or is it invisible in your own numbers? Just your view on that one.
All right. Let's start with thank you. Let's start with the last question regarding Poland. We've seen more marketing activities. However, we still believe that we are about 5 times bigger in terms of orders. So I don't think it has a material impact on us. Also, you have to bear in mind penetration in Poland is quite low. So it's easily possible that another player is getting a bit more new users by just increasing the amount of new users that are available in the market. We've seen a lot of marketing, but actually, if you look at the effectiveness of that marketing, I'm not sure whether that turns out to be a favorable investment for our competitor. But we're not worried about Poland, and Poland actually looks great also from a growth perspective.
As I mentioned earlier, Poland was still growing more than 60% on a GMV base for the first half year. And bearing in mind that the market is growing as such, so even maintaining your market share basically means in absolute terms you're widening the gap to the number 2 player. Because if you have 80% market share at a market size of 100,000 orders, then you have 80,000 orders, number 2 has 20,000. But if the market is 1 million orders and you have 80% market share, then you have 800,000 orders and the number 2 player has 200,000 orders. So your absolute gap widens while you're maintaining your market share. And we feel very comfortable about and confident about the market position at the point.
Then regarding your first question about the cost of marketing, well, of course, we do not disclose that, but what you have seen is actually that most of our offline spend, so basically television, outdoor advertisement, we've increased dramatically after the IPO, and we have explained to the market that we did that because we believe that we should reach a certain percentage of the population every week or every month. But we have also said that there's a limit to how much we can increase that offline marketing spend, because whether you reach the same person 6 times, 7 times, or 8 times, that doesn't really matter. It's still the same person. So the offline spend has actually slowed down quite a bit since the IPO. The online spend is relative to your size, so you will also always see that in increasing the more orders you do, the higher that online spend. Now, of course, we try to be as efficient as possible, and more people are using our apps. So it's not that if you increase your orders with 30%, your cost is going to necessarily increase with 30% on the online spend. But those are the 2 components of marketing. For us, actually, the more important thing is, can we get more new users against reasonable cost? So if we find some magical trick that we can actually double our marketing spend and double the new users, we will certainly do so. But if you ask me how big that chance is, I think that's 0. So I think you can expect us to continue as you've seen in the past, let's say 1 year. If you look at the marketing development, marketing cost development. Regarding Salesforce, the Salesforce and sales, I think that's probably best that Jörg answers the question.
No. I mean, so if you look at the concept of network effects, there's 2 factors which play into that. Obviously, customer acquisitions and restaurant offering. And after the IPO, we had the means to immediately increase our marketing spend. So you've seen that ramp up post our IPO. Ramping up the net additions of restaurants, that's not such an easy thing because you need to build up your sales force gradually. So we started also post IPO increasing our restaurant sales force, but it's a continuous process of ramping that up. And as you've rightfully stated, we've had the largest net addition of new restaurant in that period, which is partly driven by the acquisition of Bulgaria and Romania, but even leaving that aside and taking that out of the numbers, it was still the largest net addition we had so far in that period. And that was also obviously partly driven by Germany as being the largest market in terms of the restaurant network. So we're also happy about the development on that side because we think it's a really crucial factor to drive efficiency and to further fuel the network effects, because everything starts with the offering, the diversity of the offering, to really make the customers order more frequent and have traffic converting much better. So it's also about marketing efficiency in this aspect. So yes, we will continue to try to increase the net additions, but you will also have, obviously on a higher number of restaurants, a larger churn effect coming through. But so far, we've been managing to increase that net addition recently.
Yeah, well, Mark, with respect to your cost question, we believe that we will invest in our staff and professionalization with respect to what Jörg was saying, sales, but also in technology and product. But we believe that the cost will certainly not grow harder than they've done before, and the other expenses are highly correlated with the investments in staff. So we believe that it will be to a limited extent.
That's clear. Thank you.
Thanks.
Next question is from Mr. Hubert Chanot, UBS. Go ahead, your line is open.
Hello, thank you for taking my questions. So a couple for me. The first one is on Scoober, and I see that in Germany it's kind of been flattening as a percentage of order, 2% versus 1.9 in H1 17. So that's a quite different dynamic from the Netherlands. So I'm just wondering what kind of explains the difference, and should we expect a similar flattening in the Netherlands, and at what level? The second one, again on delivery, I'm just wondering at what point you'd consider potentially introducing a delivery fee, and how do you balance this kind of halo effect and the network effect of bringing those new restaurants versus kind of margin optimization? Thank you.
I think it's probably best that Jörg answers both questions.
Yeah. So first of all, you're right. I mean, the share of orders of Scoober in Germany didn't increase to the same extent it did in Netherlands, for example. I mean, two things to that. First of all, we didn't open too many new cities anymore. Like Jitse said, it's a lot about opening cities and about adding restaurants. In Germany, we didn't open too many new cities anymore. The other fact is that obviously Germany as an overall market grew faster, so getting share in a faster growing market is also more difficult. And thirdly, we also took some operational measures to get the business efficiency, to have the business efficiency improving, which also had some effect on that. But we will continue to see Scoober taking some more share, and as we stated in prior conversations, we'll see in the midterm that Scoober might take up about 5% of the orders in total. And that also holds true for the German market. And with regards to your last question on delivery fee, at the moment we see that as a competitive advantage. So we don't intend to introduce a delivery fee, and we don't have to, because we can afford to run it that way at the moment, because that's only a small share of our business as compared to some of our competitors who have purely logistics play, who basically can't afford to run the business that way. So we really see that as a competitive advantage at the moment, but we don't deny that maybe at some point we might think about it, but at the moment that's not an option.
Great, thanks. Just one follow-up question, if I may, on Austria. Could you maybe just touch a little bit on the competitive trend in that market? It seemed from app downloads that it was a bit of a tight market competitive in terms of competition. Could you maybe comment on what you're seeing?
Actually, Austria to us looked quite good. We have quite a gap with the number 2. If you look at app downloads, I think it's very difficult to deduce any market share from app downloads, because you can easily stimulate app downloads via all kinds of providers, and some are effective, most are not. So actually that creates a bit of an uneven picture. If you want to look at anything, you should look at the let's say Alexa, that type of data, and Google Trends. But no, we're quite happy about Austria. But of course, there's still a competitor, so it's a more difficult market for us than, for instance, Belgium or Holland.
Yeah. Thanks. Thanks very much.
So, following question is from Mr. George Pilakoutas, Exane. Go ahead, your line is open.
Hi guys. One quick one on the Scuba business in the Netherlands. Now that you see yourselves as having the biggest delivery network in that market, is there any learnings that you can tell us about, be it partnering with QSRs on the recruitment side, on the commission negotiations, and then also kind of from a drop density perspective, if there's any new work that you can update us on there. And then the second one, just on the guidance, you kind of said you expect EBITDA continuing to improve in absolute terms. Does that include a positive contribution from Tenbis, which we know had a positive EBITDA margin last year? Thank you.
So, guys, your last question is the question whether that includes Tenbis?
Yeah, is the improvement driven by Tenbis, or is there an improvement excluding the Tenbis positive contribution?
No, we haven't incorporated that transaction at all in these figures. So you should not see that as it's including that Tenbis EBITDA.
Thank you. And then just on the Netherlands, any learnings now that you're the largest delivery network there?
Well, if we can share one learning is that logistics is not a profitable business.
But we actually kind of knew that before. I mean, we kind of continue to believe that it's a very challenging business from an economical point of view. Like we said in all of our conversations, we don't believe on the bottom line you can make money with it, and it will be challenging to have on the gross profit line even a profit on this business. So as a standalone business, we don't believe that it's a promising business, but given we have a marketplace with other restaurants, we really believe in the network effect it creates for the business. And like Jitse said earlier, we also see that most of the orders should be incremental to our marketplace orders, and therefore we believe it has a positive benefit. And we also commented earlier on some of the margin or average basket value pressure you might have, given the most demanded brands is the big brands, no? And those brands, they will ask for discounts as compared to regular restaurants. So you will have continuous pressure from some of the big brands with regards to the margin and with regards to average order value, which will put additional pressure on the revenue side on this. But we've also gotten some handle in terms of utilization and efficiency, which you can see that despite actually increasing the share of Scuba from 1.2 to 2.3%, it kind of almost kept the gross margin stable. So there you could actually see that we could get some efficiency benefits through in terms of Scuba business.
Thanks.
Next question is from Mr. Bob Leo of Macquarie. Go ahead, your line is open.
Good morning. Thanks for taking my question. Two quick questions related to some that have been asked. But first on Scuba and the profitability. I mean, your peers obviously have a different view with respect to the profitability of that business. You're obviously gaining a lot of efficiency with scale. And then, you know, over time, perhaps you might introduce a small delivery fee when things are more settled. I mean, is there not a time when you see that business being profitable, perhaps over the next couple of years? And then my second question is just on Netherlands and the second quarter, 19% growth, I believe, in the second quarter, much slower than your first quarter. What about your outlook for the remainder of the year? Do you expect it to bounce back, assuming the weather sort of normalizes, or do you expect sort of the law of large numbers to put that growth rate down closer to the low single digits rate?
All right, let me first take your last question. Our growth typically is a function of what existing users do plus what new users do. Actually, both are relatively constant, but you do see that the increase in order rate of the existing users is let's call it hindered by the weather. But what is also important is, of course, how fast we grew last year, because the comp is, of course, also something that you need to take into account. Look, the only thing that we cannot do is predict the weather. But the weather does have an impact. So yeah, look, if the next month and the month after that will rain extremely hard, we're going to have more orders from the existing users, and otherwise we're going to have less orders from the existing users. That's the only thing that we can say about that. Regarding profitability in Scoober and what peers might say, I'm not sure which peers you are pointing at there, but actually if you read carefully what most people say about it, then they say something like that on the gross margin they believe that they can make a profit. And actually we don't disagree. If we would charge a delivery fee, then on the gross margin it can easily be profitable. The problem though is that you need a large HR department to hire thousands of delivery drivers every year, because the churn on delivery drivers is huge. That is insanely costly. So it might be profitable from the gross margin perspective, but bear in mind that for the marketplace orders, there is no such HR apparatus. And that is a very costly operation. Then, of course, because we have a hybrid model, we don't have an increase in marketing costs, and we don't have a headquarter cost. Well, we do, but it doesn't become more expensive because we happen to run Scoober. If you do this from a standalone perspective, of course, you do have your headquarter and you do have your marketing. But even if you don't, you have to allocate marketing and headquarter costs to it. So yes, on an Excel sheet, I'm sure it looks very promising, but we don't believe that, at least in continental Europe, probably also not in the UK and the US, this will become profitable. Maybe in China, because labor costs are very low, but it's there's a couple of drivers attached to this model, and each of these drivers needs to be at a certain level that in most of the cases none of our peers are, and also we aren't. So those are, for instance, utilization rates that sometimes we see of 4 or 5 on average. You won't get there. Yeah, peak hour maybe in Chelsea, but not overall in the city during the day from, let's say, 12 o'clock in the afternoon to 10 o'clock in the evening. So we really believe that this model is inherently unprofitable, and we do it not because we would like to have a part of the business be unprofitable, but we do believe that it is good for our business because we just provide the entire service. We don't want people to have 2 apps or to doubt whether they should order with takeaway. They must order with our website, and that's the whole mentality in this company. So this is also why we have that service, but certainly not to make a profit.
Okay, that's clear. Thanks.
Thanks.
Next question is from Mr. Rob Joyce, Goldman Sachs. Go ahead, your line is open.
Hey, good morning, guys. Just on the marketing costs, obviously running at 11% growth, well below order growth. Is there anything sort of one-off in the period there, or should we expect to see marketing growing a lot less than orders going forward? And do you have any idea in your mind what the long-term run rate is in terms of marketing growth? And then just within that, was marketing actually down or flat in the Netherlands, or is it still increasing slightly? And then the final one is just whether you've pointed to the commission increases in the period. Did you see any change in the restaurant churn on the back of that? Thanks very much.
All right, let's start with restaurants. We gave you the addition of restaurants. Please bear in mind that this is net addition and that we've increased the commissions in, well, I think all countries or nearly all the countries. So you can see that we've never added as many restaurants as we've added in the first half year of this year. So actually, we don't really notice. Actually, we are quite large for restaurants. I mean, if you turn it around, the restaurant is receiving, well, in Holland, for instance, almost 100,000. So it's about 85,000 euros in revenue on a yearly basis from us. So while, for instance, if that restaurant cancels with us, we would miss, let's say, 12% of that. The restaurant is going to miss 85,000 euros. So it's very tough on the restaurant if they decide to leave. So we didn't see anything. We actually saw the opposite movement, that we got more restaurants even in the Netherlands. So that's not a factor. Regarding marketing, you asked specifically for Holland. We don't disclose that at this point. We do disclose per country figures by the end of the year. But just in general, marketing, yeah, we ramped it up right after the IPO to a level that we believe is an efficient level. If you look at the offline spend, and as said, online is dependent on the amount of orders that we do. So the larger we become, the higher that cost becomes. But you've seen that go down quite tremendously now. And of course, if you remember, our story is that the revenue will increase a lot faster than the costs, and of course, marketing is the most important component. So you will see us continue to do that.
Oh, thanks, Jitse. Can you just remind us what the sort of mix is between offline and the online marketing spend, broadly?
It's about 50-50.
About 50. Okay. Thank you very much.
Thank you.
Next question is from Ms. Silvia Cuneo, Deutsche Bank. Go ahead, your line is open.
Good morning. I have 3 questions, please. The first is on the Germany order growth acceleration. Do you think you can continue to grow faster in the coming quarters, given the second half presents easier comps? And to what extent do you think growth was driven by transition to online in the German market overall? Then second, on the Netherlands margin, Scoober continued to have an impact in the first half. Where do you see this going longer term? And maybe can you comment on the most dense areas in which you started to do delivery first? Are you close to getting to break even there? And then finally, on the GMV, the growth was very fast. Can you give some more color about the reasons why the average basket was higher? Was it simply inflation of food or people ordering more items on average? Thanks.
All right, we'll start with the last question. Thank you. Regarding the average basket, you're right. It was quite a bit higher. Why is always difficult to determine, but it looks like people order a bit more. Well, I'm going to go ahead and call it a bit more expensive foods. So maybe they've moved out of pizza to sushi or something like that. It looks a bit like that, but it's very difficult for us to determine. It is sometimes people would say, yeah, but it's driven by Scoober. Well, Scoober has a slightly higher ticket size, but it is a very small percentage of our orders. So it's actually across the orders that we see a higher average basket. Regarding Scoober, well, we've indicated that we believe that it will move to about 5% of the orders. You've asked specifically about break even. Well, this is exactly what we're saying constantly. You know, if we can't get it to break even in the city center of Amsterdam, where we are a huge brand, then we don't believe anybody in, well, at least in continental Europe, can get that to be profitable anywhere. I mean, it would be better for us if that could become profitable, but we just don't believe in it. And I think the last question was, the first question was about Germany and the growth rate. Well, again, growth is a combination of the comp of last year, and also about the behavior of existing users versus new users. We're actually quite satisfied because obviously also in Germany it's unseasonably warm, with the behavior of existing customers, actually the order frequency and the new user additions, and that is all a result of the relative size of our brand, which is actually quite a household brand by now in Germany, and we see a lot of things improve. And I think what you are seeing currently in Germany is the improvement of our position relative to the market. But please bear in mind that still, compared to Holland, it is the Dutch brand actually towards the Dutch population is about 5 times more powerful. So we're still not nearly at the position of the Dutch brand. So there's a lot of improvement still that we can see in the behavior of existing users. And we hope and we do everything about that to get the German user to the same level as the Dutch user, and that's what we put quite a lot of attention on, and that can lead to either a higher or a lower growth in the next quarter. But we're doing all we can to positively surprise you, of course.
Ladies and gentlemen, if there are any further questions or remarks, you can still press star 1 now on your telephone. Star 1 for questions or remarks. Go ahead. We have a question from Mr. Wim Gille, ABN AMRO. Go ahead, your line is open.
Yes, good morning. A couple of questions. If we look at Poland, we see that the marketing spend, at least on a relative basis, of your competitor is going up. But what can you tell us about your marketing spend? Did you increase your market spend in Poland, and are you reacting to the increased activity of your competitor, or do you feel that you can just continue to do your thing based on the fact that you're like 4 times bigger, 5 times bigger than your competitor there? Can you give us a little bit more color on that one? The second is on the integration of the acquisitions that you did in Romania, Bulgaria, and Switzerland. I think you incorporated these activities in record time on your own platform. So you share us a little bit of feedback on how you did it and how you did it compared to, for example, acquisitions that you did in previous years. So are there any learning effects that allows you to do it quicker these days than, let's say, 2-3 years ago? And moreover, can you also give us a bit of feeling on what the churn rate of the customers has been in those markets where you integrated a new platform into your own platform? Thanks.
All right. To your first question regarding Poland, well, we don't disclose per country figures, but it's actually the same answer as the rest of the territory. We ramped up the marketing spend in countries like Germany, but also Poland, to a level at which we are satisfied and a level at which we can reach most of the population a couple of times per month. And that happened right after the IPO. So you see that for the whole company, but actually the larger countries, of course, take the most marketing spend because they are the largest countries. So you can imagine that what you see happening to the marketing expenses relative to revenue, you see that happening across the board, and including Poland. So we are not inclined to react too much to what competition does. Just so that you understand how we operate. Regarding the integration in Bulgaria, Romania, and Switzerland, yeah, you're right, it happened fast, but you also have to understand we run one platform, and we feel very uncomfortable with running multiple platforms, simply because it's very difficult to control an entity if the platform is different, because KPIs are not the same, statistics are not the same. The effect of marketing on a certain platform is not the same as what we would be expecting because it's the same platform. We know, of course, what the reaction of a certain type of marketing is to our central platform, because it should be the same reaction as we get elsewhere. And if we don't get the same reaction, then also we can look into why that is then the case. So it feels very uncomfortable also from a management perspective. If I can give you a very simple example. If we want to increase any type of marketing, we talk to our CMO and we say, okay, we need to increase this, and then it happens the next day. If you have, for instance, a daughter company in Poland, then the conversation goes like this, that I would tell Jörg, and then Jörg would call the Polish director, and the Polish director would then tell the Polish marketing director, well, these Dutch people, they've told us to do this. And then the Polish marketing director says, yeah, I've been the Polish marketing director for 5 years and I know everything about Poland, and things in Poland work differently. And then either it gets implemented, but probably it doesn't get implemented, or it gets implemented in a very different way than what we intend. So our organization structure typically is that we don't have a such conversation, and that if we make a stupid mistake, at least we can blame ourselves for the stupid mistake. So if we don't have that, for instance, we feel very uncomfortable. We don't really understand what's going on in the country and how we can steer the country. So yeah, the first thing that we did after acquiring the business was integrate it, obviously, because that makes our lives easier. It's a bit too early to talk about churns, but Bulgaria is actually looking better after the integration, and that was the first one we integrated, and that is, I think that's live for the past 2 months or so, and that looks better, so churn looks good. You're also asking about previous situations. Well, it depends a lot on the market. The Lieferando integration took us 1.5 years because we did not want to lose customers in Germany, because as you can imagine, Germany is quite important to us. And to remind you, actually, we integrated the Takeaway brand into Lieferando, because Lieferando back then was 3 times bigger than Takeaway in Germany, so it's a logical direction. You don't integrate a large brand into a small brand, you do the other way around. And we were very careful, but we lost 30% of the Takeaway customers in Germany while doing it. So even if you're careful, and I think we're really good at it, and we are becoming better at integrating businesses, even if you are careful, you're going to lose quite a lot of consumers. Now we could do it because that was in 2014, so we could afford a bit of a hit, and we're quite happy that we did it, because that allowed us to grow Lieferando to the largest brand in Germany. But you need to be very careful doing that, and it depends a lot on, again, as I said, the position in the country. We just migrated Switzerland yesterday, and we acquired it, I think, a month ago, so that was the fastest. But yeah, that was also a relatively small operation, and I think the smaller the operation is, the faster you need to integrate that. So to give you a bit of coloring.
And maybe as a follow-up on that one, since you're very uncomfortable running a separate platform, how long do you intend to do in integrating 10B's, predominantly the business-to-consumer part over there? Is that a question of months, or should we take it a bit longer given the kind of structural integration with the backend on the B2C side, or B2B side, sorry?
That will be longer for a couple of reasons. Our first concentration will be on migrating the B2B to Europe, because that's for us the most important reason to acquire the business. Another reason to do that slower is because actually it's quite a sizable brand. If you look at actually the size of that market, it would be the third brand of Takeaway after Holland and Germany and before Poland. So it's a very large food delivery market. So also there you need to be quite careful. As I said before, this is you need to be more careful with larger brands. And to put it a bit in perspective, it is much bigger than when we bought Lieferando back then in 2014. So we need to be very careful in doing that. But for instance, Scoober runs entirely on our software, so we will have to integrate that, otherwise we cannot run Scoober over there. So there's a couple of things. We will, of course, the things that we can integrate easily without any damage to the customer base, we will certainly do very quickly. The realistic answer is that it will take a longer time for the entire brand is migrated onto our platform. And we are a very educated company. We always look at what other people do better than us. So obviously we're not going to impose anything on that market that these guys are doing better than. We would rather copy what they are doing better to what we are doing here in Europe. So it's as simple as that.
Thanks.
Thank you.
Chairman, we have no further questions. Please continue.
All right, I would like to round up this analyst investor call by thanking you all for participating. Should you have any additional questions or remarks, please reach out to our investor relations manager, Mr. Joris Wilton. Thank you very much.
Ladies and gentlemen, this concludes this conference on behalf of Takeaway.com. Thank you for attending. You can disconnect your line now.